Now, August marks the 2-year anniversary of the official start of the financial crisis. Well, what lessons have we learned, and where is it going to go from here? Well, joining us now to explain all of this is Diane Swonk, Chief Economist at Mesirow Financial. Thanks for joining us, Diane.
My pleasure.
So, from your vista in Chicago, what is the single most important lesson we've learned in the past 2 years of crisis?
I guess the single most important lesson is denial. It was really amazing going back through the crisis, my own notes, and going back through all the documentation of what was going on, was how much denial there was. August 1st, 2007, the CEO of BNP Paribas announced great profits, said, hey, our risk management is so much more prudent here. We don't have any exposure to the subprime market. Less than 2% of our mortgages are in subprime, our mortgage portfolio, and we're just better at it. And in fact, just 8 days later, we saw the first of the financial crisis get underway because of problems at BNP Paribas, losses the CEO was either ignorant of, arrogant about, or simply lied. We're not sure. But the denial about the magnitude of the crisis and how it was affecting them then caused the ECB to intervene and the Fed to intervene as banks stopped lending to each other on August 10th, 2007.
And speaking of the Fed, you kind of think that there was a lack of consensus that led to some confusion.
More confusion than clarity. In fact, the actions of the Fed were simply phenomenal as we got into the crisis. September, they did a 50 basis point cut. Then we saw another 50 basis points in November and in October, actually Halloween and December. And then the Fed culminated with 125 basis points in January. They acted very aggressively, but in all those actions, there was a dissent at every single meeting. Some meetings saying, hey, we want to be inflation hawks. We're worried about inflation, like the ECB was at the time. We don't think we should be easing. Other people saying, hey, at the Board of Governors we're really worried about this financial crisis culminating in some major economic weakness, which, in fact, they were quite correct about. But all that dissent out there, transparency, be careful what you ask for, because it added more confusion than clarity to investors trying to figure out what the Fed was actually doing.
Okay, a really interesting point. Let's talk about going forward. We've got this idea from Mohamed Al-Arian of a new normal of weaker economic growth, and yet the story out from J.P. Morgan showing optimism, a more robust recovery. So which way do you tilt?
I'm actually on the rocky road to recovery. I think we're going to get close to 3% growth in the third quarter, driven by much of what Kathleen's highlighted, the Cash for Clunkers program, return in production. Basically, the bad news has abated. Autos have gone so low, there's no place to go but up, enhanced by the Cash for Clunkers. Home sales are now picking up after, exceedingly low levels, near zero. When you get to zero, there's nowhere else to go but up. But we're not going up in a major way. First-time buyers are driving the market along with speculators, but people trying to sell a home still aren't getting a good deal out there. It's a buyer's market. So all that, along with inventories rebuilding a bit, you'll get some growth, but it's half of what we should be getting given the depths of the crisis. And as we get into 2010, unless we see that emergence of good news, which is employment gains, you can't see a self-feeding recovery. I think we will see that, but even that, limited. Many companies who relied on short-term credit to finance payrolls can't anymore, even as we emerge from the crisis. We have the smallest credit markets as a fraction of the credit market coming out of the recession of the post-World War II period we've ever had, and we have very little financial innovation. That means you need cash on your balance sheet to commit to higher.
Okay, rocky recovery ahead. We're going to keep talking to you right after a commercial break. Diane Swonk, Chief Economist at Mesirow Financial. Thanks. We are back with Diane Swonk, Chief Economist at Mesirow Financial. And you were saying one of the biggest lessons we learned is from arrogant CEOs who are out of touch. Well, we've got Tim Geithner right now saying that Wall Street is not returning to its old bad habits, such as taking excessive risk. Do you agree?
I think there's going to be an inability to take risks like they used to, and I think we're going to see a lot of regulatory changes that are going to enforce that. We're also going to see a change in structure. One of the reasons that all the big investment banks made it through the Great Depression is they weren't publicly owned. They were partnerships. They had skin in the game. I think we're going to see anyone who wants to take big risks out there have to put some real skin in the game going forward. The real uncertainty right now in terms of the recovery, of course, is that regulatory framework has not been determined, which Tim Geithner is trying to push for at the moment. A lot of uncertainty about where the regulations will fall, not necessarily over-regulation or under-regulation, but we just need to know the rules of the game and where to play.
All right. And you touched upon this briefly. Do you think there's going to be a second wave to the credit crunch?
You know, I am concerned that there could be a second wave of the credit crunch. I do think the stress tests were effective. They did also take into account commercial real estate on a shadow basis through 2011, so I think that's good. So the big banks are in pretty good shape to weather the second round, the cyclical effects, rather than the structural effects of subprime. That said, a lot of the smaller banks are not getting government money, did not get the bailout funds, and they may not be as well situated to handle that, and that could cause a second round of the credit crunch or another tightening, or at least persistent tight credit markets out there, and that's going to limit our ability to leverage out of this like we did out of previous recessions.
Okay, our abilities will be limited. Thank you so much, Diane Swonk, Chief Economist at Mesirow Financial.